Hey, good morning, everybody. Today is Tuesday, the 14th, and we're going to pick up our discussion of Chapter 6, dealing with revenue recognition. You might, if you look at the Brightspace module, you'll see that there are a couple of videos. The dates correspond to the class, the scheduled class sessions. Those were not recorded those dates because of some of the issues we've had. So we've had to move rooms because of some of the, I don't know, inexplicable issues. But nonetheless, we're here until 8 if you should want to come to the live session Tuesday, Thursday, 10:30. And so just kind of bring you up to date as to where we are, because I like to sort of start our class sessions with a bit of a discussion as to what we're doing. So chapter 6, which, as I've said before, is a pretty critical chapter in this course. The quiz itself will be due this Friday, the 17th. And by the way, I don't think I'm going to get all the way through the material that I really wanted to talk about. I do want to sort of get into more of the transactional issues here. And unfortunately, we just have a limited amount of time. And intermediate accounting is just one of these dense courses where there's just a lot to do and just not enough time for instructors to talk about it. So unfortunately, some of the burden shifts to you. But if you have questions, feel free to reach out to me. I'm here pretty much every day, usually on Saturdays as well, which is when I recorded the video for what would have been a Thursday class. And the Thursday class would have been a Tuesday class. So we have changed rooms. Hopefully this is going to work out now. So the due date for the Chapter 6 SmartBook quiz in Connect is the 17th, and the homework and bonus on the 19th. And so what I'll do is I don't think I'm going to get all the way through the material that I expected to with regard to Chapter 6 today. I think what I'll probably will do is do a supplementary video probably on Wednesday, tomorrow, and that way we can kind of move forward from there. And again, if you have questions about anything that we're discussing here, feel free to get with me. Okay. All right. So let's talk a bit about where we left off last time. And remember, a big portion of this particular chapter, Chapter 6, deals with these things we call special issues or special situations and whatnot, dealing with things like warranties and additional goods. Variable consideration was a big one, and we're going to talk about that, and I think mostly finish that discussion today here during the class session and talk about what some of those are. So I want to sort of pick up from where we left off, and this is left off in my video, which you can pick up in Brightspace under the Chapter 6 module. And by the way, the modules are organized by chapters, not by week. So, some courses, delineate their modules by week and some by chapters. We're here by chapter because of the fact that I want to make sure we have enough time to cover what we need to cover during the class session. So, all right. So where we left off was this. We were talking about, and we didn't talk about this at all in the last video, was this idea of a seller versus is a principal or an agent. And this matters more from the supply side than this than the demand side. Buyers sometimes really don't care, don't know. It's not even on their radar as to what the legal relationship is of the seller to the good in question, the good or service in question. And when we talk about a principal, we're talking about, some of the more traditional understandings of what a principal is, that which provides goods and services. This is somebody vulnerable to risks associated with holding inventory. Inventory itself has got a number of issues, and we'll get to a bit later. And recording revenue, total sales price paid by customers, and we also recognize cost of goods sold, particularly in a perpetual inventory system where we debit cash or receivables, credit sales revenue, and then we debit cost of goods sold, and we credit inventory. And those are the transactions that happen. And those are the very traditionally understood transactions that we see happening, particularly in a perpetual inventory system where we're updating inventory balances constantly as new inventory comes in, as inventory leaves. And these systems are designed, these point of sale systems are designed to take inventory off the books as they're sold, or into the books as they're purchased. There's no purchases account, no purchases ledger as in a periodic system. Okay, so that's a principal relationship. We've talked about that before, particularly those of you who took accounting one. Principles 1, that was 2110, and that's really the way we sort of understand it. When we talk about an agency relationship, we're talking about a different kind of thing where the agent really has nothing to do with the good itself other than to facilitate the transaction. And by the way, there are lots and lots of agency relationships throughout the economy, whether it's realty or stock brokerage or freight forwarders or things of that nature, where they're intermediaries. Well, all they really are doing is inserting themselves in the transaction in order to facilitate the transaction between buyer and seller. And you could call these middlemen, whatever we want to call them. The issue is that they serve a purpose. If they didn't serve a purpose, I suspect they wouldn't survive very long. But it's essentially to make sure that the transaction happens. They have expertise in these particular areas. If you just think about something in real estate, where even a seller who may sell one or two houses in their entire lifetime really have no idea what the value of the home is worth, what the steps are, and all the legal requirements and the hoops they need to jump through. And they hire a realtor in order to sort of mitigate the risks and information gaps that exist. And so as a result, the realtor has no stake in the inventory itself. They just simply receive a commission. And that's essentially what's going on here, is the idea of the intermediary, the agent, simply receives a commission, and that's all that's really going on. So, all right, so when we talk about this, we'll go back to our TriBox example here, where Mike is buying a TriBox module from an online retailer. So this would obviously be a consumer individually, and he's buying it for $290. Let's consider accounting for that sale by two different retailers, and they've got them listed here. And Printco purchases TriBox modules directly from TrueTech, which is the manufacturer of these game boxes, for $240 per unit. Has modules shipped to its distribution center, ships individual modules to buyers. Okay. The other company serves as a web portal by which mobile games like this sell from products for sale. And this kind of brings up an example like, eBay and, Amazon probably is a better example here of an intermediary that does nothing but sort of move goods. And I know that your text gets into the complications that Amazon has, because sometimes they own inventory, sometimes they don't. But that's, we're going to sort of separate this out by what is the precise relationship between the seller that the individual buyer deals with. Is it a principal itself, or is it an agent? And so when we talk about the principal, and so in this case, the company that is the retailer buys directly from the manufacturer. And again, we're not even getting to wholesalers here, cutting them out of the picture altogether. And so they record $290 in revenue. Cost of goods sold was $240. Remember, that was the purchase price. So per unit, gross profit is $50. Gross profit is always expressed as a dollar figure. Gross margin, it typically is a percentage of revenue. That is, the gross profit represents gross profit divided by revenue. In the case of the agency, all they're collecting is $50 gross profit. And that's really it. Unless there are other arrangements that are going on here, that's really all that's going on. They have no responsibility for anything like shipping the good necessarily. All they are is simply representing, is simply an agent, is an intermediary in the transaction, sort of a middle actor here. And sometimes I think middleman, and of course that sounds like a gendered term, but middle actors sort of get a bad rep, but they're oftentimes very important at facilitating transactions, because they know a lot about what the buyer needs, what the seller needs. And sometimes the buyer and seller just simply can't communicate and can't get it together without that bridge in order to make it happen. And back in, many decades ago, a lot of goods transactions, physical goods, were handled by wholesalers who would distribute things like canned goods and whatnot from manufacturers to retailers, simply because the manufacturers didn't have the outreach or the connections to those outlets, those retail outlets. And so this is something to consider, is the idea that there is a role to be played, but the accounting for it is a bit different depending upon what the relationship is, whether it's a principal or agent. So a quick quiz here. Clayton Consulting operates a website that links experienced statisticians with businesses that need data analyzed. Statisticians post their rates, yada, yada, and Clayton receives 25% of the fee paid. Okay, so they collect their cut of the revenue is 25% paid to statisticians in exchange for linking buyer to seller, essentially, is what's going on here. So Loveless contacts, which is interesting. Loveless, we know Loveless here. They contact Clayton, arranges to pay a consultant $4,500 in exchange for analyzing some data. Clayton's income statement included what with regard to the following transaction. So, all right, it's 25% of it. So what would we expect to collect, right? Well, it's pretty straightforward. It's going to be $11.25. That's 25% of the $4,500 being paid. And all they are is serving as a middle actor here, sort of linking one buyer to one seller. And so that's essentially what's going on. So they don't, and it could be, maybe they take possession of the inventory or well, in this case, there's no inventory, or maybe if there were inventory, maybe they take possession, maybe they don't. That's another issue altogether. We'll get into when we talk about consignment. In this case, it's a service only. And one of the nice things about service accounting or accounting for service businesses is the idea there's no inventory. And so that kind of simplifies the overall transaction, but that's essentially what's going on. So Clayton, which is simply an intermediary, right, that connects buyers to sellers, and we have those a lot throughout the economy, and they've been around for a very long time. It's just simply because of the fact that buyers and sellers sometimes can't connect with each other, and they need some sort of clearinghouse. And these sorts of intermediaries are all over the place in the economy. The question is, how do we deal with them differently? Okay. All right, so let's talk a bit about time value of money. This is something that comes up particularly in longer term performance obligations where, you know, if you have to wait for your money for a very long time period, then maybe there's an interest amount that's imputed into the transaction. And when I say imputed, we're simply saying that we build in some sort of interest cost into this thing. As a general rule, for a very long time period, we said that transactions that happen from start to finish within a year usually don't involve this time value of money consideration. However, in the last, 3 years or so, we've had a little bit of inflation in the economy. And so this becomes a little bit more important, I think, in the idea that, you know, if we're waiting a very long time period to receive money, then we want to sort of be compensated for that. Or if we're waiting a very long time to pay money, then so the recipient is probably going to demand something from us in terms of interest. But we're going to sort of keep this within a year or longer, and then talk about what's going on with regard to this. And so we talk about the time value of money. Obviously, we covered this. For those of you who took undergraduate accounting here, we had Business 1180, where we got into decided present value and future value. The present value is always discounted to some different amount, some lower amount to some future value, simply because of the fact that $1 in hand today is worth more than $1 in the future. So if it's going to be $1 in the future, we have to discount that today because we don't have that money in hand, and we need to be compensated for our lack of having that money available to do whatever it is we want to do. So when we talk about the time value of money in this particular accounting concept, we're talking about the idea that it's a part of the contract, and there's a delivery component, which is the cash price of the good. That's nothing new here. We've already talked about that. But then there's the financing component, which is interest that's considered paid, whether it's a prepayment or whether it's later down the road in case of receivable. And I underline the sellers can assume the financing component is not significant if the period between delivery and payment is less than a year. That's not to say that there cannot be an interest component built into it. There may be, especially if we're talking about very, very, very large dollar figures. One can easily assume that a 9-month delay, you know, in some event happening is going to involve some interest component. So we need to understand that it could happen, but we're going to assume here that a year or less than a year, I should say, is going to involve no interest factor that's going to tie into the overall price. And so we talk about this. So in this case, the example is on January the 1st, TriTech enters into a contract with GameStop to deliver 4 $240 $5 modules. That's the amount that they're going to be providing to them. So combined fair value of $960. 240 times 4 is $960. Now, obviously, this is a very scaled down depiction of what reality is. I mean, they're probably going to deliver more than 4 of these game boxes, but nonetheless, you get the idea. So in this case, GameStop pays TrueTech $873 up front on January the 1st, and TrueTech agrees to deliver the modules on December 31st, so a year away. So what happens here is this. Again, the point of view is from TrueTech, and that's the point of view that we sort of are, you know, sort of viewing this from throughout this this particular module. So they're going to collect $873 in cash, debit cash, and debit deferred revenue because, number one, we have not delivered the goods yet. Now, here's the thing. There's an implied interest expense here because remember, the fair value is $960, right? So the interest expense, the difference between $873 and $960 is $87. And so At December 31st, then they're going to there's going to be a debit of interest expense, and deferred revenue is going to be wiped out. Is going to go back to zero, and they will collect the sales revenue of 960. Okay, and what's going on here is the idea that there's an amount that's being received, it's being paid in the form of interest, because of the fact that by the buyer in this case, because of the fact that they've received the goods way up front, they haven't paid it, until, or they haven't delivered the goods until December 31st. And so as a result, revenue won't be recognized until that time, which is December 31st. But they collected some amount up front, and they're going to collect, and as a result, the rest of this is going to be sort of netted out at December 31st at 960. Okay, so that's an example where time value of money comes into play. Obviously, January 1st to December 31st is arguably less than a year, but it's probably close enough that we want to include that. And so, and by the way, we go back to this idea of time value of money, which is a pretty basic concept we talked early on about. And we're going to assume the rate of what we call the discount rate is going to be 10%. Where did that come from? I don't know. It's not, we're not given that information. But all we're simply saying is that 960 is the amount of the fair value of the goods that are going to be delivered. Some of that's prepaid. Some of that's going to be incurred, though, by the seller in this case. And we're going to sort of discount some of that, which is why some of this is being accounted for here. The present value of a dollar, 1 year, n equals 1, I equals 10. And we go back to these present value tables. We have to sort of discount things backwards. And that's essentially what's going on. Where this rate of 10% came from, I don't know. A lot of times, some of this goes, it's in the finance courses where we determine what exactly the rate should be, the percentage rate should be, in order to do these discounts. And we often don't know in situations like this where we're not given it, but we just have to assume that it's reasonable. So the seller incurs interest expense because it's taken a year to deliver the product. And so as a result, they recognize revenue, but they also recognize expense. And so they're being paid up front, but there's also a bit of expense in this regard as well. Okay. All right, let's talk more about time value of money. So on January 1st, so we TrueTech enters into a contract with GameStop to deliver. Wait a minute. Let me see. So True delivers the modules on January 1st. GameStop agrees to pay TrueTech $1,056 on December 31st. So there's a note. So this is a different transaction here where we have a receivable. In this case, we do a contract with GameStop to deliver 4 of these modules. Again, the same facts really apply. All that's really involved here is just a different thing. And notice this is a note receivable, not an account receivable. This is what makes this a little bit different. The discount explicitly identifies the amount of interest revenue that's to be earned from the overall transaction. So in this case, we have a note receivable, $1,056, which is sales revenue, and a discount on the notes receivable. So again, a note receivable is an asset, and a current asset for that matter. And in this case, a short-term note. And the discount on receivable is the idea that we discount that because the fact was a time value element here. And again, the same factors are involved, the same issue, except here, the seller has a note receivable which explicitly carries interest. And as a result, we are having to record that. And again, a discount note receivable is simply this contra asset that will amortize itself over time down to zero. And that time frame is going to be very short because it's only going to be from January the 1st until December 31st in this regard. Okay. Okay, and then at December 31st, and the cash of $1,056 is received, the discount is taken out, again, reduced to zero. Interest revenue is recorded, and the note receivable is also taken away as zeroing out as a credit. So we have the debits and credits, which essentially wipe this thing out. And this is the case in which there is interest that explicitly is identified in this particular transaction, 10% interest for us to do what it is we're doing. We as the seller, and we're always in this scenario, TrueTech. Okay. All right, so let's talk about this idea of payments by the seller to the customer. I want to go back to this idea of special situations and talk about what's going on here. And here we have seller as principal, payments by seller. Oops, where's my mouse? There it is. Payments by seller to the customer. Okay. and what those may look like in terms of how we do the accounting here. So, all right, so let's talk about this. So if the seller purchases goods or services back from the customer, now why would they do that? There are all kinds of issues why. And there are all kinds of arrangements where buyers and sellers flip roles back and forth. We certainly see this in capital goods in things like sale leaseback arrangements, but really what we're talking about here is more of a short-term operating arrangement where the seller buys back some of the goods as a separate transaction. And sometimes they pay more than the fair value of those goods. And as a result, those payments, those excess payments over and above the fair value are considered a refund. So as a result, we have to deduct that from the transaction price in the overall thing. Now, how common this is, I don't know, but I think it does happen, certainly. And the idea of, maybe a manufacturer purchasing maybe shelf space from a retailer. That's one of the examples that sort of come to mind. So take things as an example, and one of the things that sort of popped to my mind was something like, let's say Fresh Pet, which offers dog food I think it's pet food, dog food, cat food, whatever, in a refrigerated space. And so not only are they trying to sell the goods to the customer, and the customer is not the actual consumer, the customer is the retailer, but also they're essentially rebating some of the purchase price because of the fact that they want space to have these refrigerated units. And you may have seen those. In fact, Freshman has talked about the fact that they need to get shelf space in retailers. You can't sell your product to retail consumers, particularly when the consumers want to see the product, feel it, touch it, and whatnot. And so this is a refrigerated unit. Refrigerated items are difficult to ship. Not impossible, but difficult, more difficult. So as a result, that's one particular example that sort of came to mind here was the idea that there's a reduction in the overall sales price because there's other consideration coming to the seller. And what is that consideration? It's the ability to get the product in front of buyers. Okay, and remember, the customer here is not the final consumer in this particular scenario that I'm talking about, but is instead the actual retailer itself. And so, all right, so what are we doing here in terms of the transaction? Well, first of all, we have to allocate the transaction price to the overall event, whatever the transaction is. We have to sort of allocate all this, and so we're going to go back here. I know I'm flipping around a little bit, but this is not something that we don't do differently. But we have this idea of we have different standalone selling prices, right? And some goods are not sold separately, so therefore there's a need to nonetheless account for the value of these goods, right? So it's not always possible for us to separate out what these prices are individually. So in this case, there are different approaches, okay, that one can use. And one is what we call the adjusted market assessment approach, and that is we're going to price the product as they are sold in the market, and that's a sort of a price approach, which is the price and exchange value of the good. And if we multiply that by the number of goods, we have a revenue approach, or the cost approach. And the cost approach is what it costs to provide the good itself. Remember, cost and price are two different things. Cost is more of an internal matter to the seller, and that is what all the costs that are absorbed into the product cost itself. And we might add a margin for what we expect to be our profit margin. That's different from the market approach where hopefully everything is built in that, and hopefully to the sellers, in the seller's mind, hopefully the price exceeds the cost. Otherwise, what is we're doing it, right? And then the final is what we call a residual approach, where we subtract what we know to be the standalone selling price, and we simply take it out from the total transaction price. This is a little bit more abstract because of the fact that we may not really know these prices very much, and so we've got to do a bit of an estimate. And I don't know how much in the homework and quiz and what you're going to see with regard to the residual approach. It's a little bit more abstract, but again, as I've mentioned many times before, there are a lot of cases in accounting, in financial accounting, which estimates are made. As a result of these, we have to sort of go to some other sources in order to sort of get the information that we need. Okay, so in this case, we're going to take an example. Assume TruTech sells 1,000 trap boxes with a 1-year TriNet subscription of $250. Okay, the standalone selling price of the trap box is $240. Standalone selling price of the subscription is highly uncertain because we haven't sold that service before. and we haven't established a price for it. So it becomes a little bit more tricky to do, right? So we know, but what we do know is the fact that we're selling the subscription for $250, which includes the box and the subscription itself, these are two different products. And we talked about this idea that goods can have two different streams of revenue going on here because there are two different performance obligations on the part of the seller. Again, a lot of intermediate accounting is from the standpoint of sellers, right? From that standpoint. So 1,000 units times 250 is 250,000. The standalone price of the try box itself, because we know we know what the price of that would be, because we would sell it. We, if we're TrueTech, would sell it for 240. So as a result, the value of the subscription must be the difference between the two, and so it must be $10,000. That's the amount that we record for that particular stream, right? And there are all kinds of examples in which we have different streams of income based upon different types of relationships. And so we need to sort of understand. So how do we book that? All right, accounts receivable 250, we book sales revenue 240, and deferred revenue of 10,000. Why is deferred revenue? Remember, deferred revenue is a liability. It's a current liability typically, unless there's a long-term aspect to it. But the seller has not yet provided the value of that. Over time, deferred revenue will get debited and will credit revenue. I guess we'll probably call it subscription revenue as a result of how we amortize that particular balance. But any kind of deferral, we talked a little bit about this earlier, was any kind of a deferral is a case in which there's money prepaid ahead of time for something that hasn't yet been delivered. And if we're the seller, we book it as a liability because we, the seller, have to deliver something. If we're the buyer, we book it as an asset because it's something that we have in our back pocket we can use. We've prepaid something, and so as a result, we have a deferral or a prepaid item, right? So it really matters as to who we're looking at here. Again, a lot of what we do here in this course is look at from the seller's point of view, because of the fact that's business school, and we're really talking about what the impacts are going to be on the seller, particularly in this particular kind of deferral. Okay. Okay, and then quick little quiz here. Allen Company wrote a contract that involves two separate performance obligations. Allen can't estimate the standalone selling price of product A. Product B is a standalone selling price of $200. The price of the combined product is $240. So how much of the transaction price will be allocated to the performance obligation for delivering product A? All right, well, this looks like it's a little bit nasty, but it really isn't, because we sort of have to back into it, really, and it's not all that challenging. The combined product is $240. We know product B is going to go for $200. And so what is 200 in relation to 240? And we have to take that percentage, and then we sort of work backwards in order to deliver the price for product A. And so the difference is going to be 240 minus 200 is 40. You can do it. The percentage method is one way that I would do it, but that may be overstating it in this case. What is 200 as a percentage of 240? And then the complement of that, it can be applied to product A. In this case, that maybe is a little bit more extreme. All you have to do is simply say, if 240 is the price for the combined product, the bundled product, right? We talk a lot about bundling. Then how do we know what the price of product A is? Well, we know it's $40 simply because the easy math that's involved in this. This is maybe one of the more straightforward types of issues. And again, we're not involving things like time value of money or anything like that. But nonetheless, these are issues that come up where sellers are really having to try to determine what is the value of the revenue that we're earning for each individual product stream. And keep in mind, too, that one of the main concerns of this particular subject of revenue recognition is that sometimes this revenue is not earned all at once. And we talked about this a bit up front. Sometimes it's earned over a long period of time. And so as a result, it's not always clear when it should be recognized. So the when and the what are both open questions at times. When it's a transaction that involves something more than I sell you something, I credit revenue, and I either debit cash or receivables, it's a little bit more challenging when there are different and multiple obligations that are going on within the same transaction. And very often sellers are involved. And again, as I mentioned in my video, this doesn't even include issues where there's another party involved, a third party, which is involved somehow, particularly in providing things like warranties and whatnot. So we can account for that. I don't want to overly complicate this particular discussion, but the idea is that we have to separate these out, and that's the important issue here. And this is why in your text in chapter 6, there's quite a lot of discussion about notes to financial statements. And I've talked a lot about this in this course, is the idea that the notes are extremely important if you really want to understand what the methodology is by which accountants are recording revenue or expense for that matter, or anything else, because there are so many disclosures that are there. And again, at the outset of this particular chapter module, there's a lot of emphasis placed on disclosure, because without that disclosure, how does one know how we record these particular things? It really becomes quite an important issue. Okay. All right. Any questions either in the class or on the Zoom call? If you want to have a little chat on the Zoom thing, you can do that. I'm here to watch it in real time. Let's go to this issue of when or as each performance obligations is satisfied. I'm going to go back to special conditions or special situations, I guess we should say, where we have different examples here. Okay, and we're going to get into things like licenses and franchises and all that. So why don't we do that? And let's just not go through the list here. Let's just do it as we come upon them. And we're going to talk about licenses, and we're going to talk about franchises and these other sorts of relationships. Consignment. We did talk a bit about consignment in Principles 1 and what that relationship is between the inventory, who has title to it, when the revenue is recorded, etc. But let's take these one at a time. Let's first talk about licenses and what those are. So when we talk about licenses, it falls in this broad category of what we call intellectual property. And intellectual property, or IP, has a lot of different manifestations. They're really legal distinctions, frankly, but from the standpoint of accountants, we're much more interested in how we treat all the issues surrounding these intellectual property items, some of which we call intangible assets, particularly things like patents and trademarks and whatnot, and how we do the accounting for those, right? We recognize there's a legal aspect to it, and the accounting treatment flows from the legal recognition of what the particular relationship is. In this case, it's a license, and so they're very often the case that sellers will license property to buyers, and maybe it's for an unlimited life, maybe it's for a limited life. We don't know. It really depends. But a license is simply this right to use something that really belongs to somebody else, and so you are given a limited right to use that, right? In other words, it's what we call a right of use. You may have, I'm sure, heard if you watched an NFL football game where they, at some point, they'll say the use of this product without the express written consent of the National Football League or the National Basketball Association, or whatever it is. What they're really saying is the idea you cannot transfer this to other parties and expect to collect money off of it. I know years ago, I had a client that owned a bunch of sports bars, across town, and this wasn't in Albuquerque. And she had a really nice business, particularly on Monday nights, where people would like pack her at the bars to, get food and beverage and watch Monday Night Football. But she was not kicking back up to the NFL. I hate to put it that way, kicking up. It sounds kind of illegitimate, but she was not, authorized to do that. And at one point, a couple NFL lawyers showed up at her place of business, and she said she was never more scared than dealing with these guys, because they said, you need to, first of all, you need to pay us back for what you've stolen from us. And she said, well, what if I drop dead? Well, then we will pursue you to the gates of hell, is what they said. So she said she was very frightened by that, and eventually had to reach an agreement with the NFL, because if you're going to show these games and you're collecting revenue from it, you have to impart some of that revenue back to the NFL or NBA or Major League Baseball, or whatever the case might be. This is an example of licensing where the ownership of the product inures to the seller. This is not like buying a toaster where I buy a toaster at Walmart. It's my toaster. I can do whatever I want with it. I can break it. I can, whatever I want. No, that's not the way this works. This is a licensed product. By the way, software. This is one of the brilliant ideas that that Microsoft had early on was that they would license software to users and not sell it. Therefore, you can only use software under a license, and that's been one of the hallmarks of that, and why Microsoft became what Microsoft is. And so you get the idea. And the question is, from an accounting standpoint, how do we recognize it? So we recognize it as a point in time when they can start using it, right? And that's one example. Other examples are things like buying a movie online. Now we have Fandango at my house, and so we'll buy a movie. We don't really own the movie; it's sort of stored somewhere in some server somewhere. And so, like, my son will watch this time of year repeatedly all the Hotel Transylvania movies, which we think we own, but we really don't own. We simply we have the right of use of those particular goods, and so as a result, we can access them again and again and again. But we pay for them up front, and that's part of the ongoing revenue stream that when it comes to intellectual property, like entertainment products, whether it's music, movies, whatever the case might be. Okay, and some of these movies have been around for a very, very, very long time, and so you have to understand that there's a very long tail on this revenue stream here. Okay. All right. When it comes to what we call symbolic IP, the seller will undertake certain activities. Number one, there's no standalone functionality that's going on. In other words, whatever the benefit the customer receives is affected by ongoing activity. This is a little bit tricky for us, particularly because it involves some legal rights of duty and whatnot. And as accountants, I'm not an attorney, so I always feel like I'm on a little bit of shaky ground here. But the idea is there's a right of access being transferred, and the idea is that when it comes to symbolic ID or IP, that we're going to recognize over the license period if there's a right of access where we've got things like trademarks, logos, brand names. Now, in accounting parlance, we would call these intangible assets. Okay, and we recognize revenue over the period of time in which we have these rights. Things like patents, for instance, have a limited life, and so the revenue recognition is going to be sort of tied to that particular time period. Trademarks, much longer time period, franchise rights and whatnot. And we'll talk more about franchises here in a minute, but when we talk about functional IP as opposed to symbolic IP, functional IP is where we transfer the right of access, and the seller is expected to change the functionality over time. This is where the product itself changes, and it could be a prescription drug, it could be software that's updated over time. And the issue really has to do with revenue recognition. As we get into specific examples here, it becomes a little bit clearer as to what we're really dealing with. And it depends upon what the specific case is as to how we do this particular revenue recognition. If it's over the license period, if it's a defined time period, we can pretty easily allocate that revenue over the period of time. But sometimes it has an unlimited life as a result. So again, these are sort of legal issues here, but we can treat them from an accounting perspective once we know what those legal issues are. So, all right, quick question here. Which of the following is not true? A, license fees are recognized over time for any license that is viewed as providing a right of access. B, licensing fees are recognized over time for licenses of symbolic IP, for which the seller expects its ongoing activities to affect the benefits the buyer receives from the intellectual property. C, license fees are recognized as revenue as a point in time for licenses of functional IP, which the buyer expects. So these are long answers, I realize that. And so the answer is going to be the last one. Licensing fees always are recognized as revenue at the end of the license period. And why? Because of the fact that the period is defined, and we know what the period is, and we know it's defined. And so as a result, we're going to provide it as revenue at the end of the license period, and we're going to sort of recognize over that particular period of time. Okay. So we're going to allocate that over that particular time. It's not an indefinite thing. It's a fixed thing. And sometimes these licenses go away. And licenses themselves are an entirely different area of accounting. I knew that I had some clients who own liquor stores and liquor licenses. And where I come from, in the upper Midwest, liquor licenses are like almost considered license to print money. And as a result, the value of those licenses were a huge amount of the asset side of the balance sheet, just simply because they were just so darn expensive and yield lots and lots of value. And And those licenses have an indefinite life. I think the life of the individual principal owner. And so as a result, licensing can be a bit complicated. I don't want to spend a great deal of time on licenses. What I really want to talk more about is getting into franchises, and we'll get there in a second. So let's kind of skip this here and move into franchises. And so when we talk about franchises, we think of franchises. A lot of us know that things like McDonald's stores are not owned in every case by McDonald's itself. The corporate entity is usually owned by some, well-off individual who, wants to diversify their holdings. Whether they own the real estate or not is maybe a separate issue, but the franchise itself is to the right to sell the product, to sell Big Macs and call them Big Macs and advertise that. And they revert some of the revenue back to the corporate parent. And most of these fast food restaurants that we see, whether it's McDonald's or, Wendy's or whatever, most of them are owned by franchises, ordinary individuals who nonetheless run the business. And what's going on here is the franchisor is the company itself that's created a particular product, and they're granting that franchisee, that is the owner of the franchise, the right to sell those products and to use the name so they can sell, Big Macs and Egg McMuffins and whatever. And it is a form of a license. There's a form of intellectual property. Okay. And there's an upfront fee typically, but there's also an ongoing amount of revenue that gets kicked back up to the franchisor over time. And it's been a model that's actually worked for quite a long time. The franchises that I've been involved with are usually that's medical doctors for whatever reason and just love buying franchises. I don't know why. I love buying franchises, whether it's Wendy's or whatever. And they don't want to run it. They want to hire somebody to run it, but they just want to own it and collect a piece of the revenue every month, every whatever over time as the arrangement goes on. And so that's what's really nice about franchises is the fact that we all sort of know what a franchise is. Now, the value that, and I don't want to get too off track here because we do want to focus more on the supply side, but the value of the buyer is we pretty much know what we're going to get if we go to McDonald's, right? We're not like hugely surprised about what the Big Mac is. It's not wildly different, if we buy in Colorado or Illinois or whatever. It's going to be the same product. And that's what gives the buyer some assurance that they're getting what they expect to get. And as a result of that, they're willing to pay what is frankly a premium price for that because they're buying what economists would call a form of consumption insurance. And that premium then leads to enhanced revenues. And so this is what makes franchises great. It's not just fast food restaurants, it's also hotel chains. It's also a lot of other types of outlets we might see, whether it's, clothing manufacturers or clothing retailers, et cetera. I mean, there are all kinds of different examples. So, all right. So, quick quiz here. Which of the following is not true about accounting for revenue from franchise arrangements? They include a franchise obligation. I'm sorry, performance obligation for the license as well as delivery of goods and services. That sounds right. B, franchise arrangements typically include one or more performance obligations. C, franchise arrangements typically include one or more for which revenues recognized over a period of time. D, franchise arrangements typically include one performance obligation. Well, that's the one that doesn't sound right because there are more than one. And when we talk about the more than one, we're saying there's an upfront cost. And I know that I've looked at a franchise in the past. It's not for me. There's usually a very significant upfront cost involved with that. And also there are multiple other obligations that go down the road because of the fact that the franchisee, the party that owns that particular license for that, and a franchise is simply a form of a license, has to revert some of the revenue back, pay it back up. And I was going to say kickback, and that sounds like a wrong term, but that's essentially what it is. They have to revert that back, and they usually get a percentage of the fees. And anyway, there are all kinds of arrangements in which we have more than one party involved in the supply side. Particularly, there's real estate involved, where some franchisees may not even own the real estate, and as a result, they have to pay lease expense on their own that the franchisor has no involvement with. And so there are oftentimes multiple parties to transactions, and this is one of the things that we emphasize a lot in intermediate accounting. Is it's not just one buyer, one seller. It could be two or three sellers involved in the same transaction for which revenue is recognized at various points depending upon what the particular issues are involved that are related to obligations on the part of individual sellers. And so one of the things that accounting textbooks will emphasize is this idea of what efforts are expended, and those efforts then which create costs, which are expected then to be matched up with the revenues. Okay. And that's the idea of the matching principle. We want to sort of match up inflows or revenues against those efforts or expenditures, those costs. And as a result, we end up hopefully with a positive value of one over the other. Okay. All right. So any questions? We got 30 minutes. We're doing great on time here. So let's talk about bill and hold sales. This is not something that is all that common, but it does happen where a seller is holding goods for some other party, and for whatever reason, and where somebody buys goods, but they don't want to take possession of them. Okay, so it's usually the seller takes possession, whether the seller has physical possession or whether there's some third party involved is mostly irrelevant. Is the idea that the buyer doesn't take shipment on these. And since the buyer doesn't have physical possession, revenue has not yet been recognized. Because remember, one of the elements of revenue recognition is the idea that we transferred title of the asset, the good, from seller to buyer. Okay. Well, in this case, the seller doesn't have the good, and maybe won't have the good for quite some time. So now this begs the question: why on earth would anybody buy a good and not take possession of it now for whatever particular reason? And it's a good question. There could be all kinds of reasons. Maybe it's startup. Maybe they're introducing a new line of business. They don't have room to store it. They want to control the purchase price. This is inventory that doesn't depreciate or doesn't lose value over time. I mean, there are all kinds of good reasons why a bill and hold transaction would be enacted, despite the fact that revenue has not yet been earned by the seller. Now, your textbook has a really interesting discussion of the fact where there have been real abuses on this. And one of these, and for those of you who like business case studies, is the case of Sunbeam, which sold a bunch of whatever it was to retailers or wholesalers, whomever it was, and said, you don't have to take possession of it yet. And they decided to recognize revenue inappropriately, and Sunbeam got in lots of trouble for that because of the fact that the transaction had not yet been consummated. The buyers didn't have it. And by the way, does the buyer have the right to say, no, I'm not going to take these goods? I suppose they could, but we're typically not going to recognize revenue until it actually happens. And so I'm not saying that every one of these particular events is illegitimate, because it's not. There are good reasons. However, there have been abuses, and one of the things that one of our mandates in all accounting courses in business schools is to talk about these ethical implications. And that's one example, one case study in which Sunbeam wanted to book revenue in that current period and say, you don't even have to take possession yet until whenever. And so they were sort of advancing revenue. This is part of the problem that we have seen happen over the last 20, 25 years, whatever the case might be. Certainly Enron was the classic poster child we talked about then before, where they're really recognizing revenue that is really not supposed to have been earned at that point in time. And so it pains me to say there's been bad behavior on the part of some companies, and so it really created a big black eye for the accounting profession. Hopefully, we've recovered some of our credibility in that regard, and just to ensure that happens, the government has been there to sort of give us a good kick in that regard. So which of the following is typically true for a bill and hold arrangement? A, revenue is recognized when goods are manufactured. That doesn't sound right? B, revenue is recognized when the arrangement is made. That definitely doesn't sound right. Remember that we can quote the price to a buyer, and that doesn't there's no business, there's no accounting event, maybe a business event, but not an accounting event. C, revenue is recognized when delivery of goods is made, or D, revenue is recognized at the point in time which payment the customer has received. All right, well, we've already talked about the idea of payment from the customer having been received as being a deferral, so the answer is going to be C. Remember, this is the wrong answer that we're being asked about here, because we can receive money up front for all kinds of things. I need X dollars up front to do something, and so as a result, we're going to sort of recognize some revenue at this point. But the correct answer is C. Delivery is really one of the key elements. And remember, it goes back to this idea of how do we recognize revenue? And one of the key elements is beyond the fact that buyers and sellers can back out up until the time of actual product delivery. Obviously, we go back to this idea of what is the transaction? What is the transaction price? What are the terms of the transaction? Can buyers and sellers back out? And does the seller have any alternative use for the particular product? But also this idea of can the transaction be reversed, right? And that is, we can cancel a transaction. And it does happen more than what you might believe. But delivery sort of consummates the transaction, whether cash has been delivered or not. And so payment is mostly irrelevant in accrual accounting. Payment, it's not, when I say irrelevant, it makes it sound like I'm discounting the timing of the receipt of a receivable or whatever. And that's not what I'm saying. I'm simply saying, how do we record the transaction? And when do we recognize revenue as a result? So we book the revenue as a credit, we debit accounts receivable. And again, we have this idea of the probability repayment is great. It's a higher standard in the GAAP system than it is under IFRS. But nonetheless, the idea is we expect to be paid for it. And if we don't, then I keep saying we, like with the seller. If we don't, then what on earth are we doing selling when we don't expect to be receiving paid? Okay. All right. So from this the natural flow of this, which I kind of like the way this is laid out here, goes to consignment arrangements. So what are consignment arrangements? This is pretty common, frankly. And to the buyer, this may be completely invisible, and the buyer could probably care less whether the buyer is a business or an individual or even a government. Doesn't really make any difference. The idea is who has legal title to the inventory. This is usually the case of inventory. I can't think of a case in which a consignment would occur when it's a service, and maybe I'm just not thinking, put my thinking cap on a little bit better, but it's usually almost always when there's inventory involved. And what happens is the consignee is a firm that has access to buyers. That's really what's going on here. And the consignor does not. Maybe they're a small manufacturer, they have no footprint in distribution, and they will rely upon somebody else. And so as a result, the consignor, who actually owns the property, is essentially lending them to the business that is the consignee that has access to buyers. Usually we're talking about the consignee is almost always a retailer. I can't think of too many cases. I suppose there are, in which case maybe a wholesaler is a consignee, but it's typically the case where you got some smaller consignor and some larger consignee. My wife had an uncle who came up with some product, and it was a very small manufacturer somewhere in eastern New Mexico, and really couldn't get access, get shelf space. Finally did it with, I think, Walmart, and Walmart said, we're not going to own the property. You're just going to give it to us, and we'll take a commission. If we sell it, we sell it. If we don't, we don't. And that was sort of the relationship. One example I can think of is, particularly when it comes to retail goods, or things like Home Depot will have like flowers outside the store, and they'll just kind of leave them there overnight. And I know my first wife was in management at Home Depot, and she said they just left them overnight. And I said, what if somebody steals them? And they said, well, we don't own them, so we don't really care if somebody steals them. That was part of the arrangement, was the idea that we don't own the flowers. They're sitting out 2 a.m. Somebody could drive by and take them. Now, obviously, that's not legal to do, but nonetheless, that doesn't stop people from doing it. And they really could care less. They were saying, look, you're a florist. You want us to sell the goods, we'll sell them, and we'll take a piece of the action, and we'll remit that back to you. What we don't sell, we'll give them back to you. There are all kinds of other examples, things like newspapers and some health and beauty aids, particularly things which have a very short shelf life, where magazines and newspapers, a lot of businesses don't want to own those because they're going to, who wants to buy a 5-day-old newspaper, right? So as a result, that's a consignment type of good. And when it comes to bigger dollar figures, one example would be things like artwork. And I think this is particularly important where you're an artist and you want to sell a good. You're a painter or you're a sculptor, and you don't really have access to buyers, but you'll find an art studio that will take it on consignment. You still have legal title. It's your property. You can take it back, presumably, whenever you want. And if the seller can sell it to somebody, the seller will take a percentage commission that's agreed upon ahead of time. They'll take that and remit the difference back to you. And it really makes a lot of sense because the fact that what the consignees are trying to do is simply to bridge the gap between buyer and seller, because the sellers oftentimes don't have access to buyers. for whatever reason, lack of distribution capability, lack of marketing expertise, whatever the case might be. The key thing is that we've got some personal item that's involved here, okay, or some item, whatever it is, okay. Okay, the quick concept check or a quick quiz here is Alex Guerin is an artist who sells his work under consignment and in local barbershops. Now, I saw this, I thought, I don't know how common it is to sell artwork in barbershops, but okay, let's just kind of go with it, right? And customers purchase his work there, right? So I would have gone a different way, but nobody asked me. So Garrett, who's the owner of the property, recently transferred a painting on consignment to a local seller in this case. After Garrett's transfer of payment, barbershop painting what? Well, is it the barbershop's inventory? No, it's not. Should it be counted his inventory? Yes. And that's really the issue here is the fact that it's not title is not transferred. All they're doing is holding it. And without getting into issues of insurance, who has to insure it, and who has liability if the thing is stolen or damaged or whatever. The idea is that it remains in the inventory of the consigned or who has title of the property. So consignment arrangements do not qualify for revenue recognition. And remember, we're back to revenue recognition. They don't qualify for revenue recognition until that delivery is made to the final buyer, who may be completely unknown to the owner of the property. And so as a result, again, we come back to this idea of intermediaries in the economy, which are very, very common, particularly in physical goods, where buyers and sellers can't get together without any other sort of intermediary arrangement. Okay. All right, so questions about that. Now, obviously, this is as I mentioned before, this is a very dense chapter. I'm not going to be able to get all the way through it, and but we are going to talk more about this. I'll probably do a supplementary video probably on Wednesday, the 15th, because obviously you've got work due the 17th and also the 19th. So there's a lot to do. I do want to make sure that we sort of cover this. Obviously, for those who are majors, you want to make sure that your instructors at least talked about some of these, as well as the fact that the capstone course incorporates a fair amount of material from intermediate accounting. Okay, again, intermediate accounting being that sort of that linchpin of any accounting education. Okay. All right. So, any questions before we move on to the subject of gift cards, which I think is an interesting subject? There's really nothing terribly complicated about them. What is a little bit challenging is the idea of how we recognize revenue over time. Because so if somebody buys a gift card, and by the way, I don't know about you, but I've got like a whole drawer full of gift cards people have bought me over time, Starbucks, Applebee's, and for Christmas and whatever, and I just forget to use them. I don't, whatnot. I think my wife is going to throw some of them out, and I'd say, no, there's still value on this. So, but but let's take it from the standpoint of the seller. Somebody comes in, they want to buy a gift card and $50 to Starbucks or whatever, right? Well, Starbucks, obviously they're going to involve a retailer, and let's not overly complicate the transaction because they oftentimes sell them through Smith's and Albertsons or whatever, Walmart. But it's a deferred liability, right? It's a deferred revenue because you're being paid up front for something you haven't delivered yet. So they'll record debit to cash, credit, deferred revenue. And you're only going to recognize revenue when the thing is redeemed, if it's redeemed. The big question is, or the likelihood seems remote. This is a little bit more complicated because who knows, right? I think I've got gift cards from years ago, and I don't think they expire at all, but I could probably redeem them. They're probably 10, 15 years old. But at what point did Starbucks or Applebee's finally decide to recognize the revenue, saying, this guy lost this in the back of his couch, or his house burned down, or whatever, right? Presumably, they would honor it, but who knows? Now, by the way, there's an interesting case that just happened within the last, 4, 5, 6 months, where TGI Fridays, which most of us may know, it's a restaurant chain, and the restaurants themselves individually are franchise owned, right? Obviously, TGI Fridays is the corporate parent, and they would issue gift cards that were redeemable at franchises. And the franchises then would turn those redemptions back over to the company for reimbursement. Well, the problem is TGI Fridays was in bankruptcy. And I don't know where they are today, October 14th. I really don't know. But I know the big question was franchisees were saying, hey, you're in bankruptcy. Are we going to be able to collect? Or are we going to have, because maybe there are, I don't know, X number of gift cards floating around out there. Is everybody going to be swamping our restaurants to redeem their gift cards? And we have no way to redeem them from you because you're in bankruptcy, and we fall back behind, in the chain of value, right? There's always this pecking order when it comes to bankruptcy, and that was an interesting situation. I don't think I've ever come across before, where you've got an issuer of a gift card, which is the corporate parent, that has this deferred liability. They have an obligation to perform, but they do it through their agent, in this case, which are franchisees. And the franchisees were a little bit reluctant to do it, and they didn't know what to do in this particular case. And I guess I was curious at the time. Maybe I should follow up here to see whatever happened, but I thought this was a really interesting sort of case study, sort of almost made for business school case study as to what happens when this deferred liability, this deferred revenue, has to be made good on, but it's been made good on some other party, and the actual compensating party here may not be around. And that's a really interesting thing. And so, and it kind of goes to this idea of, if you get a gift card, maybe the moral is, if you get a gift card, you should probably use it. I'm not saying Starbucks is in danger, or McDonald's or whatever, but maybe you ought to redeem it at some point soon. Okay. All right. Noah sells gift cards, redeemable for Noah products, either in store or online. During 2021, he sold 6 million of gift cards. 5.4 million were redeemed in that year, so that's an easy recognition. We delivered the product to the customer. We recognized 5.4 million. As of the end of the year, 450,000 of the gift cards have passed the date in which Noah concludes the cards will never be redeemed. Now, 1 year may be a little bit tight of a time frame. I don't know, and this is an area that I will admit that I don't know what their recognition is, and I don't even know if FASB has weighed in on this someday. But so the question is, how much gift card revenue should Noah recognize in 2021? Well, the answer is going to be they redeemed 5.4 million. They have 450,000. They think it's never going to ever come in. It's fallen in the back of someone's couch. It's fallen out of the wallet. It's whatever, right? So as a result, it's going to be 5.85 million. That's the 5.4 million that they've actually delivered product to, and then and they recognize the rest, which, by the way, is pretty good business for getting paid for something you didn't actually have to do. So, and I hate to put it this way, but it's a great thing you earn revenue for not working, right? It really is. And so, in this case, there's a recognition that it's not ever going to be redeemed, and maybe they're probably right. By the way, when we talked, I think a bit about discounts in the previous video, where a lot of times companies will offer discounts to buyers, and the buyers just simply never get around to redeeming coupons and whatnot. And there's been quite a lot of research and literature on the subject of discounts, where firms sort of understand and anticipate the fact that they're going to offer a discount, but they're never ever going to have to redeem the coupon because people are never going to send them in because I guess buyers, I don't know what, can't be bothered to do it. So you get the idea. It's a similar arrangement. It's different, but it's similar in the sense that a revenue recognition happens without any real effort at all. So smart buyers will exercise all their rights to exercise the asset that they've got at hand. Okay. All right. So we only have about 10 minutes or whatnot. So I want to talk a little bit about this idea of deferred revenue. And we'll talk about contract liabilities and contract assets. This is a little bit more complex. And the textbook just sort of breaks this out between balance sheet items, income statement items, which are relatively straightforward in terms of things like bad debt expense, interest revenue expense. Bad debt expense is obviously an estimate based upon what's usually informed by past experience and by future expectation as what may happen with receivables that may or may not be collected, or even notes, not just accounts receivable, but also notes. When it comes to things like contract liabilities and contract assets, these are things that are a little bit more abstract, and we want to talk a bit about that, including this idea of what the uncertainty is in the timing and how we recognize the revenue, because again, that's sort of the main topic here. And this gets us into some of the longer term issues concerning revenue recognition. Now, I'm going to probably not have time today to talk about this, but we're certainly going to get into this idea, particularly when it comes to long-term obligations. So when we talk about deferred revenue, first, contract liabilities. Well, contract liabilities, I think that the exemplar for that is deferred revenue, right? When we have an obligation to do something, we're contractually obligated to do something. You paid me up front for whatever it is that I'm going to do, and I'm going to deliver it to you. You paid me $10,000 to paint your house, and I've got to go do it, right? In other words, that's a contract liability. That may not even be recorded unless we cross accounting periods, but nonetheless, it is a liability, and that's one of the more common ones. Where it gets a little bit trickier, I think, is when we have a much bigger dollar figure and we have a longer time frame, and that deals with what we call contract assets. And contract assets tend to be most often associated with longer term obligations. Construction is sort of the case in point here, where and we're not talking about construction of a gazebo or a deck on the back of someone's house. We're talking about building something like a hotel, an office building, a submarine, whatever the case might be. And so as a result, how do we recognize revenue over that long time period? And we're going to have to pick this up in subsequent videos, but the idea is that we associate with these long-term projects, and particularly when the revenue that's been earned that it is greater than the contract billings. And we're going to get into these asset accounts and what they look like, because the contract asset is, well, it's an asset. Why is it an asset? Because it's work that's not yet been completed, but it will be done. And then we have a way to move the asset itself from that to a receivable, ultimately to recognize the asset, and we'll sort of get to that. So I'm going to kind of skip this because this is really sort of wrapping up all these topics we've covered here, dealing with special situations. All these things, consignment, franchise, licenses, time value of money, all of these. And so you can kind of look these over for yourself and kind of go from there. And I do want to sort of, because we only have just a short time period here, when we talk about revenue disclosures, what do we have to know here? And the idea is, so let's take a look here. So which of the following is true about revenue disclosures? Sellers do not have to separate their revenue. Sellers do not need to describe their outstanding obligations. C, sellers must disclose any significant judgments used. D, sellers do not need to explain. Well, the only one that really stands out here is C, because it's the only one that offers an affirmative explanation. The rest are sort of negative in the sense of what sellers do not have to do. This is one where sellers do have to do it, to disclose any significant judgments. And judgments it really means, in this case, estimates, and that is how we've arrived at the estimate, how we logically construed what our obligations were, what our revenue to be expected are. The rest of these do not really apply. This is the correct answer is, and the key thing is about disclosure. And for public companies, which is typically what we're focusing on in intermediate accounting, publicly traded companies, we're talking a lot about the idea of notes to the financial statements as being quite dense, oftentimes, with information, and even as dense as they seem to be. And I've looked at my share of publicly traded companies, 10Qs and 10Ks. Sometimes they don't even answer all the questions, and so as a result, this is why the quarterly conference calls sometimes are necessary in order to quiz the CFO as to, hey, what exactly do you mean by this, or whatever. Because it's not always straightforward as to when, in this case, when revenues are earned, but also other issues that we will cover later, such as how expenses incurred as well. Okay. All right, and let me see here. So the final thing here, because we've almost out of time, is accounting. We're in our part C of this particular module. We're not going to obviously get to it here because this is a class that ends at 11:45, but we want to talk about this idea of long-term contracts. And this, in my mind, if there's probably anything which is mostly associated with this particular chapter module, it's this idea of long-term contracts, particularly regarding construction. And we've created lots of assessments in this course around this idea of long-term obligations. And so it goes back to these idea of long-term contracts. But then again, these are not really anything different than what we talked about before when it comes to how we do these sorts of recognition, right? And if we go all the way back here, and I mean all the way back, I think it's back, not even special situations. This is just in general where we identify the contract, identify the obligation to be done, transaction price, allocate that price, and then recognize the revenue when each obligation is satisfied. So these things go way back in the very beginning of this. And again, I know it's a very dense chapter, but there's a lot of things talking about. So in this case, 2 and 5 are identify what the obligation is. What is it? We as a seller, and again, we're typically talking from the supply side point of view here. What is it we have to do in order to that we've contractually obligated ourselves to do? And oftentimes we'll create a single performance obligation because sometimes we can't separate these out. And this is where construction comes into play. And when we talk about construction, I mean, you could break out the cost of roofing and electrical, and drywall and tile and painting. I mean, it would just be really monumental to do. Instead, why not just have one single performance obligation from a general contractor? The individual subcontractors have their own problems to deal with, but one particular performance obligation. And again, construction is sort of tailor-made for this. There are other areas of the economy where it will work as well, but this is probably the most straightforward means of presenting it. And then we recognize revenue when before each obligation is satisfied. There are different ways to do this, and we can do it over time according to progress toward completion, right? Which I think is well, not I think it's the favorite method, or we can simply recognize the whole thing as the contract is done. The problem is in accrual accounting, one of the things that accrual accounting seeks to do as a major objective is to recognize revenues and expenses as they're being incurred, regardless of when payment is made or whatnot, assuming the payment is mostly guaranteed or assured. But if we push it back to contract completion, we're going to have a major distortion in revenue if it's a 5-year contract or whatever to do whatever it is we're doing. Maybe 5 years is a little bit long for construction, but you get the idea. So over time is probably, well, it is the most preferred way of doing it. So, all right. So, and we're going to give an example here, and this is we're going to stop here because I just don't have time to get into it, and it's going to be a good jumping off point for this discussion about how we do the two different approaches, right? And we're going to present them two different ways. We're going to say over time, we're going to book revenue as we earned it, also incur the expenses as we incur them, and then we're going to compare and contrast that with the idea of over at the very end of the time period and all that. So that's where we're going to sort of go. I'll probably pick that up tomorrow. So we're getting closer to this chapter. There's a lot yet still to do. It's just a very dense chapter, which is why we don't really have time to cover it in class, which, you know, those of us who do this and understand what we're doing, understand that there's a lot going on, and there's a lot going on for you. And I realize this is not the easiest course in the world. And there's a lot happening, and we sort of recognize that. So, all right, before we wrap it up, are there any questions for me today, either in class or on the Zoom call here? Okay, well, if you do have questions, feel free to reach out to me. I'm available, and we can talk more about what's going on. Particularly if you have questions regarding the quiz or homework, I'm available, or bonus. I'm available to do that. So I will see you all on Thursday, and what I hope to do is to press into the next chapter, just because I want to sort of keep moving here. I know I've deferred some of the due dates to give you more time to do things, but there's a lot to do in this course, and so we're going to sort of keep up the pace. Hopefully, I'll get through the rest of this in a separate video. It's going to be posted in Brightspace. The link is going to be in Brightspace, and we'll pick this up from there. And then the next class session, we'll go forward with the next chapter. Okay. All right. Have a great rest of your day. See you next time.